Welcome everyone to our final video in this series of analyzing all 30 Dow Jones Industrial Average stocks. If you did miss the first two videos, I will link the first video in this series up in the top right corner right now. I'll probably link the second video towards the end of the video, so you can catch up on the other 20 stocks that we've already analyzed so far. Real quickly, before we get into the analysis, if you could please drop a like on this video, it would mean a ton to me. Also, leave any comments down below if you want to see any stocks analyzed. And with that, let's get right into this with Microsoft Corporation, ticker symbol MSFT, which is a system software company with a current market cap of $3.33 trillion. Microsoft is currently trading at 13 times its price to sales, which is 38% above its long-term average. It trades at a 35.5% premium to its long-term price to earnings average. On a price to EBITDA basis, the stock is trading at a 27% premium, a 30% premium to price to EBIT, and a 36% premium to price to free cash flow. On a book value basis, Microsoft looks a little bit better at only 14.71% overvalued and 26% overvalued on a price to tangible book. It's also interesting to note that the company trades at a 36% premium to its long-term dividend yield. It used to average about 1.08% over the last 5 years, but is currently trading at 0.69%. The company also trades at a 32% premium to its average enterprise value to EBITDA and a 41.5% premium to its long-term enterprise value to free cash flow. Taking a look at the drawdown chart, we can see that Microsoft is generally a very stable company, only drawing down 20% or more twice in the last 10 years. It's currently in a 5.13% drawdown, but very close to all-time highs. And then finally, taking a look at the X factors, this company is expected to grow at 13.26% per year, which is quite good. Its PEGI ratio is 2.65, which is a little bit above average, and its EFGY ratio is 3.88, which is very above average. Neither of these numbers, plus everything we saw earlier, indicates that Microsoft should be a buy right now. Next up is Nike, the footwear giant with ticker symbol NKE, and this company currently has a market cap of $115 billion. Unlike Microsoft, this company trades at a discount in many different fashions, in this case a 36% discount to its price to sales. Nike also trades at a 38% discount to its long-term average price to earnings ratio, although I do want to point out a bit of bumpiness on the price to earnings estimates for the next few years. Price to EBITDA is also at a 36% discount. Factoring price to EBIT shows a 39% discount, while price to free cash flow shows an astounding 61% discount. Nike's discount at price to book value is at 37%, and its price to tangible book is again about 37 or 38% discounted. Nike is even trading at a 62% discount to its long-term dividend yield, which is currently yielding 1.88% versus its long-term average of 1.15%. Its enterprise value to EBITDA is at a 38% discount, and its enterprise value to free cash flow again shows a massive discount of about 62%. If we take a look at Nike's 10-year drawdown chart, we can see why the company is showing such a large discount. It's basically in its largest drawdown over the last 10 years, currently sitting at down 55.5% and reaching a maximum of down 59% in July of this year. The company is expected to grow at 8.39% for the next 5 years. Its PEGI ratio is 2.15, which isn't terrible compared to other companies we've seen on this list, and it has an FG ratio of 1.72, which is definitely one of the better numbers. Third on our list is the current market powerhouse. That is Nvidia Corporation, ticker symbol NVDA, a semiconductor company and currently the largest market cap company in the world with a cap of $3.29 trillion. Nvidia trades at nearly double its long-term price to sales average, though it currently only trades at about a 2% premium to its long-term price to earnings per share average, an 18% premium to its price to EBITDA, and only a 3.5% premium to its long-term price to EBIT. On a free cash flow basis, Nvidia trades at about a 32% premium, but these premiums get much larger when we look at price to book, up about 178% overvalued and 138% overvalued on tangible book basis. Taking a look at its dividend yield, Nvidia trades at an 88% premium to its long-term dividend yield, although this company doesn't really focus on dividends, so this is a little less relevant. It trades at a 22% premium to its long-term average EV to EBITDA numbers and a 36% premium to its long-term EV to free cash flow numbers. Nvidia is basically at all-time highs right now, but I do want to point out that this company regularly draws down quite a bit, drawing down over 50% in 2018 and again over 65% in 2022. And with one last look at the company's X factors, we can see this company is expected to grow by nearly 38% over the next 5 years, which is massive and really brings down the next two numbers and makes them quite reasonable, with a PEGI of 1.39, which is one of the best we've seen, as well as an FG ratio of 2.05, which is certainly not terrible. Procter Gamble is number 4 on our list, and this household product company's ticker symbol is PG, with a current market cap of $403 billion. Procter & Gamble trades at about a 17% premium to its long-term price to sales average, a 23% premium to its long-term PE average, although future earnings may justify this premium for the time being, an 11% premium to its price to EBITDA, a 10% premium to its price to EBIT, and a 12% premium to its price to free cash flow. On a book value basis, PG trades at a 14% premium and a 64% premium to its price to tangible book, which has seen significant deterioration over the last couple years. Procter & Gamble trades at a slight 12.5% premium to its long-term dividend yield, with a current yield of 2.24 versus a 5-year average of 2.56. Its EV to EBITDA ratio is currently at 17.35, representing an 11% premium, and its EV to free cash flow is at a 12.5% premium. Taking a look at Procter & Gamble's 10-year drawdown chart, it looks like this company is quite volatile, but I want to draw your attention to the scale here. The largest dip that we have is only 27%, and that occurred in 2015. So only on 3 occasions has the company dipped further than 20%, and the most recent of that being in 2022. And finally, taking a look at the X factors, this company is expected to grow at about 7% per year for the next 5 years. Its PEGI ratio is 3.18 and its FG ratio is 3.47, neither of which are great, but for such a defensive company, it's not terrible. Halfway through today's list, and we are talking about Sherwin-Williams Company, ticker symbol SHW, which is a specialty chemicals company. You're probably familiar with their paints, and it has a market cap of $91.5 billion. SHW trades at a 37% premium to its long-term price to sales average, a 21.5% premium to its long-term price to earnings, although this might be justified by future growth if analyst estimates are correct. The company trades at a 25% premium to its price to EBITDA and a 21% premium to its price to EBIT. On a free cash flow basis, that premium gets wider at about 37%. It trades at a 23% premium to its price to book value and a 71% premium to its price to tangible book value. Sherwin-Williams also currently trades at about a 21% premium to its long-term average 5-year dividend yield, a 25% premium to its average EV to EBITDA, and a 37% premium to its average EV to free cash flow. And taking a look at the drawdown chart, we can see that, again, this company is near all-time highs, about 3% drawn down, but we can see that it regularly draws down at least 20% on a scale of maybe every 2 to 4 years, and occasionally those drawdowns become 30% in the case of the COVID drawdown, or all the way up to 42% in the case of 2022's drawdown. SHW is expected to grow at 9.97% per year for the next 5 years, which is pretty solid, but this does not help its PEGI ratio at 3.39 and certainly does not improve its FG ratio at 5.02. So this company does not represent a very good buying opportunity currently. The next stock on our list is a controversial one at the moment. That is UnitedHealth Group, ticker symbol UNH. And just so you know, I'm only talking about the stock in this video. Currently has a market cap of $479 billion for this managed healthcare company. UNH trades at a 5% premium to its long-term price to sales average and currently trades at a large 60% premium to its PE ratio, although I will say that the future earnings of this company do justify the current price. To further back that up and show that UNH is basically at fair value, it's trading at only a 9% premium to its long-term average price to EBITDA, and again, about an 8.5% premium to its long-term price to EBIT. We are going to ignore the price to free cash flow number because it has been negative most of the time. UnitedHealth does trade at a 6.75% premium to its price to book and a 1.4% discount to its price to tangible book value. It also trades at a very slight premium of 2.67% to its long-term dividend yield, only a 7.75% premium to its EV to EBITDA, and once again, EV to free cash flow shows some pretty awful numbers that we are going to ignore. Now, this company does regularly draw down about 10 to 20% every couple of years, and it's currently in a drawdown of about 10.75%, so certainly nothing out of the ordinary for UnitedHealth Group. Taking a look at the company's X factors, it's expected to grow at about 15% per year for the next 5 years, which is pretty solid growth, giving it a PEGI ratio of 2.05, which is pretty favorable compared to many other companies we've seen. Its FG ratio is basically unhelpful. It's negative 13 due to the fact that its free cash flow has been negative. And we are getting towards the end of our list here with number 8, Visa, which is ticker symbol V, a payment processing company with a current market cap of about $617 billion. Visa's price to sales is currently at a 12.5% premium to its 5-year average. Its PE is at a 7.5% premium to its long-term average, although well justified. The company trades at a 13% premium to its price to EBITDA and a 13% premium to its price to EBIT. price to free cash flow does show a higher premium of about 32%, and the company trades at a 30% premium to price to book and a 48% premium to its price to tangible book. Dividend yield numbers look better, trading at only a 13% premium to its long-term average. Its EV to EBITDA is about a 15% premium, and its EV to free cash flow is about a 35% premium. Visa is a remarkably stable company, drawing down about 30% only twice, once during COVID and once during 2022, and generally only drawing down about 10 to 15% at worst, with its current drawdown sitting at only 1.29%, basically at all-time highs. And continuing with the X factors, this company is expected to grow 12% for the next 5 years, giving it a PEGI ratio of 2.51, which is not great, but certainly serviceable, and an FG ratio of 3.7, which is certainly much worse, and we'd hope to see the free cash flow numbers come back to something a bit more favorable. Our second to last stock is Verizon Communications, ticker symbol VZ, which is a telecommunications services company with a current market cap of $178 billion. Verizon is currently trading at a 14.5% discount to its long-term price to sales, though these sales numbers have been flat for many years. It does trade at a 47% premium to its long-term PE, although if analyst estimates are correct, this company should be at a discount shortly. Its price to EBITDA is a 12.5% discount versus its 5-year average, and its price to EBIT is a 9% discount. On a free cash flow basis, Verizon's trading at a 72% premium to its long-term average, although that average is highly skewed by a super negative number in 2021. On a price-to-book basis, Verizon's trading a 31% discount and a 25% discount to its price to tangible book. The company also trades at a 17% discount to its long-term dividend yield, currently yielding 6.3%. On an enterprise value to EBITDA basis, Verizon's at a 12% discount, and on an enterprise value to free cash flow basis, it's at a 72% premium, although again, this is quite skewed by 2021. VZ is in the midst of one of its largest drawdowns in a very long time, currently 31.74% off of its all-time highs. And taking a look at the X factors, this company is expected to grow at 2.4% for the next 5 years, which is very slow, giving it a PEGI ratio of 2.1, which is respectable, but an FG ratio of 6.05, which is just bad. There's no good way to put that. And we have made it to the final stock, and of course that is Walmart, ticker symbol WMT, the consumer merchandise and retail giant, with a current market cap of $757 billion. Walmart's price to sales is a massive 75% premium to its long-term average, with a 45% premium to its long-term earnings per share average. And I bet you're starting to see a theme here. It's currently trading at a 72% premium to its long-term average price to EBITDA, and a 70% premium to its average price to EBIT. Free cash flow is somehow even worse at a 97% premium to its long-term average, and the company trades at an 83% premium to its price to book and a 58% premium to its price to tangible book. Taking a look at Walmart's dividend yield, it does trade at a 48% premium to its long-term average, only yielding 0.85% currently. And when we factor in the enterprise value, again, it looks terrible. EV to EBITDA, 75% premium. EV to free cash flow, a 100% premium. And if we take a look at the company's drawdown, we can see it's at all-time highs. Walmart is performing excellently, but the numbers say that it is quite overvalued right now. This is a very stable company, though, only drawing down larger than 20% 3 times, with the most recent time being in 2022. Finally, taking a look at the X factors, Walmart's expected growth is 9.5%, which is quite good for a company this large and a retailer in general. But its PEGI ratio is 3.75, which is not good, and its FG ratio is 6.45, which is even worse than Verizon. So not something that we really want to invest in currently. So with that, we have gotten through all 30 stocks in the Dow Jones Industrial Average. If you missed the videos, again, I'm going to link the second video in the top right corner right now. Go to the start of the video and check out the link if you want to get to the first video in this series. Please don't forget to leave a like on the video if you enjoyed this series, and leave a comment down below if you want to see one of these stocks analyzed. And with that, guys, I hope you have a wonderful day. I will see you in the next video. We will be back doing single stock analysis here, starting with the next video. Take care, everybody. Bye.